Hello and welcome to the market update here for Tuesday, July the 11th. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. We're kind of at a stage, at least on the charts, where we could go either way. We'll look at those here in just a second. As far as the direction alerts are concerned, remember, all these are showing is the market stretched one way or the other, overbought or oversold. We're kind of right in the middle. Momentum is right in the middle. So we could rally higher. We could drop from here based off of where we're at on these indicators. And so I think a lot of what happens next will be where we break on the trend lines I'm going to show you here in just a second on the charts. But breadth has been picking up. Now, remember, breadth was lagging for a long period there. Remember, we talked a couple of months ago, we were talking about those 7 stocks, those mega cap tech stocks that were leading the rally, were basically the only reason why the market, the NASDAQ was rallying. Well, now you're seeing breadth pick up. More stocks are participating. In fact, a lot of those mega cap tech stocks are showing a little bit of buying exhaustion. Some of them have rolled over a little bit. We'll take a look at those stocks here in just a second. By the way, we're not going to look at those 7 stocks every day. I mean, you go back, if you were to look at some of the archived recordings of the class, you'll find that we'll focus on certain things at certain times, and then we don't look at them again, or we won't really focus on them again. And again, that's what the market does. It tends to focus on certain things at certain times. And you want to pay attention to that, because that's what the market is focusing on. And that's typically what's going to drive the direction. And so now we still want to base our decision on the chart, what the chart is telling us. But we also don't want to be ignorant to what the market is focusing on, and I do this with trades too. It's like, that's where the greatest number of people are going to be focused on. The human nature element of trading plays out the best. So if you've ever analyzed or gone through Elliott wave analysis, it's based off of human nature and what we do, the patterns we develop, just in the decisions we make collectively as a group. That collectively as a group, we tend to be very predictable. Individually, we can be pretty random sometimes, but collectively as a group, we tend to be very predictable. Now, not perfectly predictable, but the patterns are pretty reliable. And so when the larger the group, the more reliable that human nature pattern or behavior is. And so obviously the stock market is the biggest. I mean, it's really the biggest area of where human nature plays out on a daily basis in the world. And so you're already in the area where these patterns, these predictive patterns can play themselves out. But then you try to focus that on to where the majority of that collective crowd is focusing on. And if you do that, then you're going to be, especially if that's an important part of your analysis, which it is for me. It's not the only thing I base a trade on, but it's something I look at and study, and it's spooky how accurate it can be in many cases, especially combining it with your chart analysis and candlestick analysis and things like that. But so we tend to kind of focus that on, we tend to try to focus on what the market is focused on. And so the point I'm trying to make is don't get so caught up in it, though, to where 10 years from now you're still focusing on something the market was focused on 10 years ago. You've got to be fluid there and adjust and adapt to what it's focusing on now. And this is where, if there's any value in turning on CNBC, there's very little value nowadays. There's a lot of people I've respected or valued their opinions. Not that I there's anyone that I follow their opinion exclusively or over my own intuition, but a lot of the really good names have kind of gone on and moved off, and some of the newer people I have on seem pretty clueless to me. But they'll kind of guide you to what everyone's talking about. They're kind of dialed into, the big fund managers and banks and things like that, and what they're trading, and you'll see it on the stocks that are actually moving. Right now the big focus is on artificial intelligence, and that's anything that's AI is moving the market or moving the stock, and so we need to focus on that. We need to pay attention to that, whether you agree with it or not, whether you think AI is going to take everything over or it's just a fad. It doesn't matter. That's what the market's focused on, and so we're gonna kind of focus on that as well. All right, so Brett, though, there is higher participation going on. Sentiment is still extreme now. This I was told, and I mentioned this earlier, that this sentiment indicator, there's a little glitch they're working on, because it was at the extreme. It was all the way to the right side here forever, and not that it can't move back all the way over to here, but the problem is it's moved back over there without any significant fear entering into the market that would cause it to go back that far. So they're working on that. Just be aware that the sentiment is still pretty extreme, pretty complacent, and there isn't any significant fear or concern in the market yet. But remember, volatility is cyclical. When you're in these periods of very low volatility, you're more likely to move at some point to a period of higher volatility. We've been in this period of low volatility for so long that we're bound to get a decent sell-off at some point in time. Now, again, you're not going to base a trading decision on that alone, but you start to see trends get stretched. You start seeing bearish reversal candles. Those could be signals that a pullback could be starting. And a lot of times you think a minor pullback should happen, and it ends up morphing into a much bigger correction. And so as of right now, I look at the charts as being in an area where we should see at least a small pullback. But we're also in an area in the bigger context where you could see a bigger correction take place at any time. But trying to time that bigger correction, I've been talking about it now for a couple months, where it's building towards that, and we might expect something like that. It hasn't happened yet. So again, you continue to kind of trade the current trend, and what, if you'll notice in the portfolio, what I've been doing is adding some positions. Once we moved above that 618 retracement level, and I'll show you what I'm talking about there when we get to the chart. You had to force yourself to be more bullish until the market behaves differently, until it starts selling off more significantly. You got to start adding, not crazily adding. I didn't say we had to go all in and put all of our capital at work. There's still danger of a bigger correction taking place, but if it does just keep grinding higher, we don't want to miss that either. And so now is the time we start adding some positions, and that's what we've been doing over the last couple months, and doing pretty well. The account is now up to close to 150,000. We were stuck at that 137,000 level for a long time, almost a year, and now we're starting to build gains in the account, starting to grow it again, which is exactly what you would do in what we went through. You get into a bear market, you get defensive, you try to preserve capital. We did that. We were almost all in cash during that big decline last year, ending in October. We still traded, but some of it were inverse ETFs that went up when the market went down. a lot of it was just churning sideways. But the point of that experience, if you've been through that whole year with me, is that capital preservation. You want to keep what you already gained. We had big gains the year before, and you want to preserve those gains and keep that profit. And then if you can preserve capital and you do bottom out at the end of a bear market, then you're able to ride that next bull market up and continue to grow your account. And so that, although there were many months where we didn't do a whole lot and classes might have been kind of boring, that's what happens in bear markets. They are boring. There is a lot of just waiting until it's over, unless you have other ways to trade. I trade options primarily, and you can trade bullish moves and bearish moves, and so if the market goes down, I tend to use put options instead of shorting stocks. But that's something that you could consider adding to your knowledge once you get get a good system down for longer term trades, to be able to switch over and or to be able to learn some new techniques that can allow you to make money when markets go down, to give you something to do while you're trying to get through a bear market. And then there's last May where it went sideways, where almost nothing really works in that condition. You don't want sideways markets for a long period of time. Buy-sell ratios, we're seeing the buys outpace the sells, but still not stretched. We're not seeing a wide range. Even that's not a wide range. This is more of a extreme range there. So again, market could go either direction. This sentiment indicator has pulled back. We're not near an extreme. It wouldn't take much of a rally, though, to push this to that extreme. And so if we did, on the chart, when I get to the chart to show you the breakout levels, I'll show you where the next level is. That if we did break out from here, not too far away, where we'd be overbought again, and that might be the next area where you'd expect a pullback to start if we do break out higher from here. All right, so let's take a look at the charts. One thing to keep in mind, well, first of all, let's look at where we're at right here. Let's back out to a 2-year chart. So the last key area that we were focused on was this previous high right here. Now, these lower highs on the way down become resistance on the way back up. The market has to try to push above it. And if it can push above it, that's a bullish sign. It's a bullish signal. If it can't and it pulls back from those areas, now it could be just a temporary pullback. It just be a correction within the uptrend. But these are key levels that we want to focus on. And so the next one is up here at about 460-ish, somewhere in that area there. Could be a little bit below that. Now, I try not to get too focused on an exact spot with this analysis. I tend to look at zones or areas. You can see there's a little bit of resistance right here that's just below that. Here's a little bit of a support level that kind of lines up maybe a little bit above that longer line. The bottom line is there's a lot of resistance in this area here. Okay, there's also a little bit of a blip right here, and a little blip right here, and a little blip right here. This could be an area that the market kind of reacts to as well. It doesn't jump out as strongly as this high up here, but the market has reacted to this area several times, and so that's an area right around, let's say, 450. So if we rounded these to 450, 460, that's pretty easy to remember. This 450 though area is not. This is what I'm talking about. If we do break out higher here, it wouldn't take very long to get to 450. We're basically 440 right now, so another 10 points on the S&P, and indicator that we were looking at, the right here on the sentiment indicator right here, would probably push to that overbought area right here pretty quick. Okay, that's what I'm saying. It wouldn't take much to get there. All right, so let's go back to the S&P chart. Now, from a bullish standpoint, this is exactly what you like to see on a breakout. So this is that significant breakout. It broke out, and then it came back down and retested the breakout right there, and it held. Okay, that's a bullish sign, but it also means then that this is a critical support area right here. If it breaks below that, that's pretty bearish. Okay. That means, and again, not bearish in that we're going to come all the way down and test the October lows, but it would mean that we're in a larger correction, something like this, where you had a larger pullback, still could maintain the uptrend. And as I've been mentioning, the fact that we moved above, and by the way, this when I talk about the 618 retracement level, this is that 618 retracement of that entire move down. At 61.8%, it's a Fibonacci level. When you get above that, it doesn't mean the market can't drop. So the rule, the concept is that stocks will tend to retrace about 50% of their moves. So if you're in a downtrend, stocks will tend to retrace about half the move, and then continue lower and retrace about half the move. Now, because we don't expect exactness in our analysis, there's a range, of Fibonacci ratio range that is anywhere between 38.2% or the 382 retracement level to 61.8% of the 618 retracement level. Again, those are Fibonacci ratios. You can view some training on the site related to Fibonacci analysis to go into the education tab. So, when it gets above that 618 retracement level, that's kind of the limit of how far you can retrace before going lower. Not that it can't go lower still. You can't have deep retracements. But again, the probabilities start to shift. And that's all we're analyzing here is the probability shift. It becomes less likely you're going to get that bigger move down, more likely that you're actually working your way up, that you're in an uptrend, although this does not look impulsive, does not look like an uptrend, strong uptrend. It is what it is, though. It's in this area where that probability is shifting. As long as it holds that and keeps moving higher, you have to kind of force yourself, and I've kind of forced myself to turn more bullish. Okay. Although again, if it breaks down back below this level, because of how many times it's hit it and it's reacted to it, if it gets back below that, that would not be very bullish. And it could just be that the market is, going into one of those bigger corrections like it did back here, comes back down a little bit, and that would be good. It should come back into here, fill in this area, and have allow for a healthy rally from there. A lot of these stocks are stretched. They've gone too far too fast. They need to pull back, and how we pull back tells us whether the trend is still bullish or bearish. If it pulls back in more of that choppy kind of fashion, that ABC fashion, it tells me that, hey, that's just profit taking type selling. It's not panic selling, and the trend is still strong. The dip buyers are going to be confident to jump back in and keep pushing the trend higher. If it's really impulsive and it really shoots down and that VIX spikes up and there's fear, then maybe it is leading to something where it retests those October lows. If this is more of an impulsive move down and sharp drop, that tells you that it's more likely you're going to go lower and that there's further to drop. So the problem is we're not getting a pullback enough to where it's alleviated that overbought condition of the market, and we're not getting a sharp enough sell-off that's telling us that we're going lower. We're kind of in limbo. And when we're in this limbo state, we tend to look around and say, okay, well, what could break us out of this? We did this a lot back in May. Remember, it's like it was the Fed meeting, and then the next jobs report, and then the next CPI report, and none of them were breaking us out of that range. And I'm kind of getting the feeling that kind of we're back into that again, where we thought, boy, the jobs report would solve it, and the market did rally. It did try to rally a little bit on that jobs report. Now we do have a CPI report coming out tomorrow morning, and again, that could be a driver. And I don't know which way it's going to push the market, but that's what we're going to take a look at here. So we've got this little near-term resistance right here. The market has had trouble breaking above. So if it can break above here, that would be bullish. That means the market's probably going to continue higher. And in the near term, I keep talking about the market being overbought, but it's more overbought in the longer term. And I'll show you what I mean by that here in a second. In the near term, we can still push higher. We're not in that extreme reversal risk range here. So we could push out above there. But that's what I'm saying is if we do break out above there, you're going to get into that extreme reversal risk. You're going to get that sentiment indicator pushing to that red line on the direction alerts there, and that means that maybe the pullback happens a little bit later. So again, it's one thing recognizing the market should pull back soon. It's another trying to know exactly when it's going to pull back. Back here, I thought it was starting. Remember this was that bearish inside week. I'll show you again. We did another bearish inside week last week, so that could be your bearish argument that we're going to head lower off of that CPI report. That could be an argument there. But again, from a chart standpoint, in the near term, we're in limbo right here. It could go either way based on what I see here, and we don't have that stretched element one way or the other to help us know which is more likely. And so it's kind of in a coin flip area right here. And I don't like to do a lot of heavy trading in these areas because I feel like I'm guessing, and I like my trades to be in line with what I think the indexes are doing. And the whole reason for that is I'll mention it again. I've mentioned it many times before, but I always have new people. Approximately 80%, you could make the argument it's 70 to 80% or something, but about 80% of the stocks are going to follow the major market averages. So anytime you see, and usually it's when they're up pretty big, over 0.5%. Usually if it's over 1%, it's really more, it's close to that 80%. So if the S&P is up 1% for the day, there's a good chance that 80% of the stocks out there are going to be up as well. Now, they're going to be up by different amounts. Some could be way up, some could be barely up. But there's a lot of momentum in your favor. So it only makes sense that, hey, if I feel the indexes are going to be up, why not do a bullish trade? Because if about 80% of the stocks are going to be following the major market average, then my chances of that trade working out are much greater. If only 20% are going to go opposite of the major market averages, now I've got to go try to find 20 stocks out of 100 that might work out, that I could short or be bearish on. I'm not saying that I don't do that sometime in option trades, because I might see a real short-term pattern that I love and it works a high percentage of the time, but it's counter trend. But my general philosophy is to try to go with the flow of the market. Now, with option trades, I do it very short term, meaning what do I think the market's going to do tomorrow? Do I think it's going to be up tomorrow or down tomorrow based on what I'm analyzing? And then I try to make my short-term trades based off of that. So we got two different styles sometimes that come into these discussions. I look at what I think could happen immediately, and then what I think could happen over what is the trend over the last few weeks? Are we trending up or trending down? And those could be important factors as well, although not always as important for very short-term trades where you're going to be in and out overnight. But we're in a limbo area where, whether you're analyzing what could happen over the next week or what could happen over the next day, we're just in a spot where it could go either way. So this is going to be your bullish. This is really easy to see the bullish line right here. Now the strong bearish one is going to be below here. Remember that was that major support level we broke, resistance level we broke above and came back and retested. But you could also draw a little trend line through here. You got a little bit of a triangle formation. If we break below this area right here, we're probably going to get down to this area right here. So in the very near term, if we break below that, we're probably heading down into here. And then what do we do from there? Do we hold that? If we break below it, but this is where you turn a lot more bearish, is if it breaks below that low. Okay, and then bullish above here. And like I said, we're kind of right in the middle. But this right here will give us a little bit of a clue that it's more likely to at least get to this low right here. So let's watch that. So this would be mildly bearish if it breaks below here. Very bearish if it breaks below this area. And this would be, I'm going to say, mildly bullish if it breaks above here, just because it probably won't run very far before you're bumping into that next resistance. And then now you've got an overbought market bumping into that resistance. Okay. So to be honest, it would make more sense that the market would rally up into that overbought condition and then pull back. But remember, we're not the only ones that see this or analyze this. There's a lot of other people that are looking at that next level. And this is something I mentioned a while back when we broke out of let me go back to that 2-year chart. Because when we broke out of this level right here, or wait, maybe it was back here. Yeah, it was back here actually. It was this level right here. And this was the next level to break above. And I felt like, and everyone was focused on that. Here's the next level. I felt like maybe the market would reverse somewhere in here. If it was going to reverse, it would reverse in here where really no one was expecting it. Everyone's expecting that next level. The market will tend to do that. It will tend to fool the most people as possible. And if the crowd gets too focused on one area, it won't tend to make the obvious move. It won't tend to do the obvious thing. Sometimes it will be close, or it does it once to suck everyone in to think they know what's going to happen next. But it will always tend to surprise. And this is why a lot of the class, this class is based off of looking at different scenarios. I call it game planning, like you would a football game. We don't know what's going to happen next, but we're ready for whatever direction it moves in. We look at the key levels and say, okay, if it breaks above here, that's going to be more bullish. We kind of have an idea of what the market should be doing at that point. If it breaks below here, that's more bearish. I need to force myself to look at that alternative. So the next obvious area is right here. Now I did show you one that's a little bit obscure. Not as many people. It's not as obvious as that one. And maybe that's the area that it looks like it's pushing towards. It might. So let's say we break out above here. It might look like we're going to push towards here, and then it goes up a little bit further. All these people are buying that breakout. Oh, we're going all the way up here, and then we get a reversal candle right there, and then it drops. Again, I'm just game planning right here, looking at. I'd love to see what if I got a bearish reversal candle right here. Well, that could mean we're getting that pullback, so that's what I'll be watching there. Okay. All right. Now, a lot of the other charts are going to be about the same as far as what we're looking at. The Dow. I actually had a short-term bullish trade on the Dow overnight because we had this little bullish candle right here, and then we have this big gap down from it was Wednesday. It was Wednesday to Thursday. This was Friday, and there's a tendency to fill the gaps, meaning trade in the area of the gap. And we pretty much did that today. At the highs of the day, you could make the argument we filled that gap. And so I got in and out of that trade. I caught this little move right here. Now, what happens after that? I don't know. I'm not suggesting it's going to come right back down. But you're looking at kind of the same scenario here where you got this resistance. If it breaks above here, that's bullish. If it breaks down below here, that's bearish. And we're in kind of that no man's land. And on top of that, you got a little bit of a spinning top candle kind of forming, that indecision candle. Boy, does that price action make sense when you know the context? We're in this range right here. We're in the middle of that range, and then you're seeing indecision. This is why I love looking at this stuff. I love teaching this stuff, and hopefully you guys love learning this stuff, because it makes a lot of sense. The market moves start to make a lot more sense when you can read that momentum change, that behavior, and the market's telling you it's indecisive, or it's telling you it's strong, it's confident, or not confident. And again, it's not perfect, but man, when I learned this stuff, it just made everything. It made me pretty comfortable in feeling like I know where the market's going. Again, day to day, and there is back and forth, but and we can't perfectly predict each day and each move. But man, from a probability standpoint, you learn how to read this stuff, and you're going to be on the right side of the trend and of the momentum most of the time. And or if you're going to do counter trend moves, you're going to do them with your eyes wide open. You know what you're doing. You know you're doing a counter trend trade, and but it's not ignorance in which you're doing it. You know the risk you're taking in doing a counter trend trade, and so you're going into it with your eyes wide open. The Nasdaq. Now the Nasdaq's been lagging everything, and this has been the leadership. Like I said, we'll go through those leadership stocks here in just a second. But this is a real simple range right here. And we're right in the middle of it. And we're showing indecision right here. Above is bullish, below is bearish. And right now we're guessing, to be honest, if we're making a decision on where we think it's going to go. Now, you could make the argument that, probably in again. Where have we been going before this range? Well, we've been trending up, so the stronger probability would be that we're going to break out higher eventually out of this. Now it could kind of dip back down to the lower part of the range, hold that, and then break out higher. But we'll see. Now the Russell's already at that resistance area right here. We'll see if it kind of underperforms, or maybe tomorrow's the CPI report comes out tomorrow, so tomorrow morning, and so if that's what the market's going to focus on or pay attention to, that'll be the driver. But below here would be bearish for the Russell. And again, you're bumping up against this resistance, and what's the candle right there? And again, this could change between now and the market close, but it's showing an indecision candle at this top right here. Now, before I move out of the indexes, I told you I was going to show you, we can look at the weekly chart on this other charting service here, and we did this back here where we had, remember, each one of these candles represents 1 week of trading. And a couple weeks ago, we had this bearish inside candle. That's a bearish reversal candle right there. Usually you're going to get a pullback out of that candle. We didn't. It shook it off and went higher that next week. Well, what happened last week? Well, we got another bearish inside candle. Now, do we shake it off again? We could. I mean, all these are showing are weakness in the uptrend. It's showing that we should be pulling back. Here was a bearish inside candle that led to a pullback. We can go back. Here's kind of a bearish inside candle led to a little bit of a pullback there. We could go back further and find them. Here's one that didn't lead to a pullback, but a couple weeks later it did. So it was an early signal that you were kind of topping out or peaking out a little bit. So I don't know. I don't know what'll happen. I mean, these are not going to be perfect. And inside candles aren't the strongest reversal. I'd much rather see a shooting star candle formation or a black candle formation. Black candle is when it shows up on this charting service, which is why it got the name. But let's see if we've had one. There's a little one right there where you close lower than where you open, but still higher than the day before. In this case, you close lower than where you opened the week, but still higher than where you closed the day before. So we'll show that you're up for the week, but it's a bearish reversal, and it shook it off a little bit the next week, but then it did drop and dropped pretty good right here off of that. So I'm still going to be looking at that range that I just showed you, but I did just want to point that out. We did have that bearish inside week on the S&P. On the Qs, it kind of was opened a little bit higher than that candle from the week before, but it's showing the most weakness this week in comparison. So we'll see. We'll see if that means anything. All right. I gotta move through some of the stuff here. Bonds. Now, bonds have made. We talked about the bond yields, especially on the 10-year going up. We did it does look like we're kind of holding this support level as of right now, but this is a critical support level. If it drops below that, we're probably heading back down to these previous lows right here. We've been stuck in this range. We've talked about that. It's worth talking about it now because we're at a point where it's a critical spot right here. So let's zoom in. And you can see that on the lows that we hit yesterday, we bumped into that previous low in March right here. We're trying to rally a little bit today, but notice that indecision candle. It's not real strong. You got a little bit of, now you broke this little support level. Could that be resistance? We'll see. And what this is telling us is that bond yields are going up. What's the significance of that? Well, again, these big professional traders, especially when you have a market that's run up like it has this first half of the year, are you going to be able to get that big return in the market through the end of the year, or is the market in an area where it could start pulling back? You've got these attractive yields in bonds right now where you've got a guaranteed pretty much 4% or what have you. If you want to move money into bonds, and the higher that rate goes up, the more it tempts these fund managers to just take that return. It's a guaranteed return basically. You don't have any risk or very little risk. And so that's kind of what's going on. And you can look on this other charting service. We can look at the 10-year yield, and I told you to watch that 4%. And sure enough, we hit that 4%, and then we've just backed down the last couple of days. Although this is looking like a little bit of a hammer candle formation. we'll see if we're going to see yields push. Now, I think what's going to happen is the market's waiting for that CPI report. But if it shows that inflation isn't dropping this strong as the market has hoped, or if it ticked up a little bit at all, you're going to see these yields probably take off, and that's going to create a market sell-off if that were to happen. But keep an eye on it, because this is what the market's focused on. We're not going to be looking at the 10-year yield for the next 6 months, but this is what the market is really kind of watching or focusing on right now. And you can see it as soon as it got to 4%. The market kind of pulled back a little bit, and then now that's kind of backing. We see it back down below 4%. The market's rallying a little bit off of that. If it continues to move lower, again, it makes the bonds less attractive, makes people more likely to look at stocks as their vehicle through the end of the year, and that would tend to be a little bit more bullish. So we'll keep an eye on that. And if you can't pull up this chart, just look at that TLT chart. And if we break below this support area right here, then that's going to probably be more bearish for the market. It means those yields are going higher. And it has that inverse relationship when you're looking at the TLT chart. Just so you know, this going down means those bond yields are going higher. All right. Gold, I'm not going to spend too much time on this. It's pulled back significantly, and this is more attractive to start trading gold, but this looks kind of corrected to me. It looks like there's still danger. It could have another move down. What I want to see off of a bottom is I want to see an impulsive move. I want to see it go up, 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 up. And then when it pulls back, it'll be more choppy and corrective. That tells me there's a better chance that you're rolling over or rolling back up into an uptrend. This is more choppy after a move down. This is too dangerous that it's still trending lower. So I'm going to assume this is still trending down until it proves me otherwise. And that's going to be my outlook there. Oil's looking more bullish. We had kind of highlighted this range right here. We had stuck in that range. We're breaking out of it today. So oil's looking more bullish in the near term. Let's look at the longer term chart right here. And that was a significant breakout. Look at the support right in through here. Got a little bit of resistance right in through here. We broke out of that. This is probably your next target area up here to watch. But it's starting to have a look of maybe starting to transition into an uptrend. It's still early, but this is what I like to see, is that you start to see higher lows. It could be in starting the early stages of moving back up. Now, if we really start getting an impulsive move higher, then that would confirm that it's probably turning the corner and rallying back up. But you can start taking a look at some oil stocks and maybe beat down a little bit, see if there's some attractive trades there. The dollar. Again, the dollar's kind of correlated with that bond yield. Rising bond yields is bullish for the dollar. Falling bond yields is bearish for the dollar. Remember, the last 2 days we saw the 10-year pull back, and so it's not surprising we're seeing the dollar kind of pull back with it. Now, could this be just a correction? It's just kind of a cup with handle formation where it starts a very bullish formation there for the dollar. We'll see. But the near-term trend is down. We're just waiting to kind of see, is this part of that larger correction starts to move back up. Again, this ties back into that bond yield, though. Keep an eye on it. Wherever that bond yield is going is probably where the dollar's heading. Now, it's not always going to be correlated that strongly every day, but that's kind of what's happening right now. So we'll pay attention to that right now. The VIX is this would be a bullish argument in the near term, was that we had a little bit of this black candle formation, bearish reversal candle right here. Maybe the VIX pulls back into this level right into here, maybe fills in this gap right here. So this kind of looks near term that maybe we could rally a little bit. But you're also starting to see the VIX ever so slightly start to you saw this little move higher right here after this decline. It's starting to look like it's picking up, the volatility is picking up a little bit. Now we're still at very low levels. 20 is complacency, or is kind of a complacency level. We're well below that. Got all the way down to 13. But there again, understanding the cyclicality of volatility, that when you're in a period of low volatility, you're more likely to move into a period of higher volatility. What we're looking for are signs that the volatility is picking up. And we did see that right through here, that's picking up. The question is does it come right back down and go lower? Or I think what's interesting today is that we're up a pretty decent amount. And yet the VIX really hasn't dropped much. It's still kind of elevated from where it's been. So I think there's a little bit of that concern out there. Again, nothing that's really screaming anything. If you believe the VIX is telling you something every single day, you're probably overanalyzing it. Maybe I'm overanalyzing a little bit in class today. But just generally though, I want to point out kind of that it looks like it's kind of the volatility seems to be picking up a little bit. Again, this is not what you would base an exact trade on, but it's important to kind of keep an eye on those subtle changes that are taking place. SMH, I pointed this out, that it seems to be underperforming, had a lower high right there. You could probably draw a little bit of a triangle formation here. If we break out above here, that'd be more bullish for chips in general. Bearish candle today would lead me to believe it's more likely to at least move back down to this support area, maybe break it, who knows. Last we were talking about the possibility of a little bit of a bearish head and shoulders pattern right there. It seems to still kind of be holding that. In general though, you're seeing it looks like it's kind of rolling over a little bit. Now that may change, but again, as of right now, it's not strongly telling me it could still go either way right here, but it looks like it's losing a little bit of that momentum that it had up through here. Transports have been, here's your really bullish argument though. Transports have been on fire. It broke out of that key resistance level that we were looking at right here. It came back and tested it, and now it's shooting up higher again. So boy, I can't see a significant pullback, particularly in the Dow, unless you start seeing transport stocks correct. And so this would be a strong bullish argument for the market, is the fact that transports are really kind of leading the way, which they should be. Now I switched the Bitcoin. I've been meaning to do this. It's just I keep forgetting to do it. But we were using GBTC. This is a Grayscale Bitcoin Trust, kind of an ETF where you can trade Bitcoin without actually owning Bitcoin. We've been using this as kind of our Bitcoin chart. The problem with this is it trades on the OTC over the counter. It's not a major exchange. Volume is not too bad, 270 million shares, but the fact that it's trading on that over-the-counter exchange is really unattractive. I've been waiting for them to kind of solidify that, because they were working on a Bitcoin ETF. It kind of got it going now. It's a little bit better trading instrument for Bitcoin. It trades on the Amex, and it has, you can see, 6 million volume. So there's a lot more liquidity in it. So I'll be using this as kind of the Bitcoin chart. But Bitcoin still looks pretty bullish to me. We had this sharp move up. This looks just like a correction of that move. I think it should start to take off again. In our portfolio, we had a stock that was tied to Bitcoin, Riot. It's done really well. In fact, I'm going to exit Riot today, and I'll explain why here in just a second. But and I'll tell you what I'm going to do next out of that. Now, real quickly, I wanted to look at those mega cap tech stocks. We'll go through this real quick here. NVIDIA, again, it's just kind of flatlined right through here, but I don't know if that's kind of wave A, wave B, and you're going to get wave C coming down, but it could go either way out of this range. But it's the key thing is it's kind of stalling out. It had that big, huge move up right through here, and it's just kind of stuck. There's indecision now. Really expensive as far as valuation, so that could factor in it. So it probably is going to move whichever direction the market moves. The market starts taking off, people jump into an overbought stock or a high valuation stock. They don't care. They just want that momentum. But it could pull back pretty significantly if there's any sort of sell-off just because of how big of a run it's already been on. But that's showing that momentum is slowing down. Microsoft, it looks like it could be in a wave C, wave A, wave B, wave C. So notice again, these are starting. This is why we're looking at them. We want to see some signs that they're rolling over. These were the 7 stocks that were leading the whole rally a few months ago. So if they start showing that they could pull back a little bit, there's a good chance the market will follow at some point. Apple is finally starting to see a pullback. Now, could this just be a dip to buy? Yeah, it could be. But at some point, you've already been buying the dips. Bought dip, went higher, dip, went higher, dip, went higher, dip, went higher, dip, went higher. When you get up into this range right here, all those dip buyers think it's guaranteed. Oh, this is going to go higher. And that's when you get that larger correction because it'll fool them. And what will fool them is if this is wave A right here, the dip buyers say, oh, buy today. Even though it's down, it's going to go right back up. And it does go up a little bit, but it's wave B. And they start piling in. Here we go again. And they're even more confident because it's happened so many times through here. And each time they wish they would have risked more, right? They wish, I should have traded even more. I wish I would have put more in. Now they do put more in because it's even a bigger pullback right here and a better entry point. It's going to go right back up above here and higher, right? No, that's the sucker's rally right there. And then you get wave C, and then what do? They start selling in a panic because they're like, oh no, we're going lower. I'm losing all this money I gained on all this dip buying up through here. And they start to kind of panic sell a little bit. I'm talking more of the retail type traders in that scenario there, but the fact that we're starting to roll over, and this is a deeper dip than these shallower ones back here. And the fact that you're getting a deeper dip near the top of a run up, a lot of times that can lead to a little bit bigger correction. Now, how would this jive with the market going a little bit higher and maybe breaking out of that range? Well, maybe Apple goes higher, but it lags. It doesn't go up as strong. That'd be a strong signal too that that's a wave B and that's got a wave C coming. It's not participating very much in that rally. It's going up, but not participating with the market breaking out. And then when the market pulls back, it'll have that bigger move down at that point. AMD really wasn't part of that 7, but I've added that in. But it's rolled over already. Google has already been kind of dropping down. Now you could make an argument that now that's a pretty decent pullback. Could it start going up from there? Yeah, this is pullback to most of those 7 stocks. But if the other ones really haven't pulled back and they're kind of trading as a group, you could make the argument there's a little bit more downside on Google still. Amazon just looks like it's barely rolling over. Notice how it broke that uptrend line right through here. It kind of broke it. It's trying to rally a little bit today. It's starting to roll over a little bit. Now, I've seen plenty of times where it looks like it starts to roll over and then goes one more burst higher and then it drops. So again, you never want to get too locked in to say it's got to. The strongest argument, the strongest reversal would be if you had a sharp sell-off and then that choppy rally back up, where it looks like that's wave A, wave B, and then you're going to get wave C, kind of like what Microsoft looked like there, or was that Microsoft or yeah, Microsoft. Or that could be wave 1, wave 2 to get 3, 4, 5. I mean, this is just showing little subtle signs of rolling over, but not something strong yet. Tesla, again, could this could just be a quick dip filling in the gap, and then maybe it tries to go higher. We'll see. But it kind of looks, it looks like it's, again, if you look at, here's the run up, it pulled back. When it broke out higher, it didn't go very much higher before it immediately pulled back again. That's a very shallow higher high right there. All that's showing is momentum slowing down. Doesn't mean the trend has to reverse, but I want you to recognize that signal. Buying exhaustion is a signal you want to pay attention to. It's not, you don't necessarily want to trade it as a exact timing signal, but it's something to kind of pay attention to, that momentum is slowing down a little bit. Netflix, again, this wasn't one of the original 7, but it's one of the FANG stocks, and so kind of threw that in there. Meta hasn't shown any strong weakness. Still in that uptrend, so maybe it's when Meta starts breaking down that you've got a little bit bigger correction in those stocks. All right, real quickly, let's look at the portfolio, and here's Riot. Look at that parabolic move. We're now at the extreme reversal risk right here, far right side of it, and we've gone straight up. Now, stocks can't maintain that forever. And yes, there's a chance it could still go higher. And yes, maybe I'm getting out too soon. But remember what I've talked about this a number of times. It's a weird dynamic that people can get more upset about missing an additional gain than they can with taking a loss. I'm not that way, or at least not in a strong way. I mean, that's still part of human nature that we all have to deal with. But I'm okay with, to me, the way, when I see something like this, what I know is stocks will fall a lot faster than they rise. And a lot of times they come back, they retrace that parabolic move sharply when they do finally start selling off. Let me give you an example of C3AI did this. It went on this parabolic move right here, and then look at how fast it dropped. So if you were trying to squeeze out that extra gain right here, you're trying to get that extra $1 gain, and you end up with a $4. You give back $4 or $5 of profits because you were trying to get that. You're greedy. You're trying to get that one more dollar. So how do I deal with this? Well, there's different ways that you can deal with this. I mean, I'm not suggesting that what I'm going to do is the best way. If you're really in this, you don't care about the near-term fluctuations, you really have a long-term outlook on the stock, you could just sell some of it, sell some shares. We've got 800 shares. Can you sell half of them, 400 shares, and take some of the profit off the table? Do that. Could you raise your stop? You could, but the problem with raising the stop, I think our stop is down here. Maybe I could raise it to right below here. The problem is that, again, these things can come down as sharply as they go up, but you could easily get stopped out on just a normal correction of that move. And why not get out of here with that extra gain? So there's pros and cons to anything you can go through of how you want to manage it. It really depends on what you want to do. My thought process here is you've had this parabolic run, paid off nicely for us. Get out. I can always get back in. So let's say it pulls back out of that parabolic move back to the breakout area and then starts to move up again. Well, I'll jump back in it again, put a stop down below here, but now it's consolidated the move, and now it's a better entry point to get back in. What if it continues to go higher? What if it has another big burst higher tomorrow? Okay, so be it. I'm not going to get too worried about it because I made a good chunk through here. This is not a normal move for stocks, and when it happens, it doesn't happen very long usually, and And like I said, it can turn very quickly when it pulls back. You look at it went up really strongly here, and look how fast it came back down. And by the time you get out, you've only made a little bit out of the move when you had a chance to make a lot. So I'm going to go ahead and sell that. See what our nice profit is right now. Well, let's see, what is it at right now? It's at 1762. $17.62, 800 shares. We made $5,000 on that trade. Okay. We're at $150,000. We're stuck in that 137 range and 138 range for so long. Now, a good chunk of that, not all of it, but a good chunk of that was that riot trade. And that's what we hope for. We have all these stocks that are just kind of chopping around a little bit, and then you have one that takes off. That's how trading works. You think all of them are going to take off. That's why you're getting in the trades. But usually you can pinpoint your profits to 2 or 3 trades that made most of those profits. It's like that with any trading system out there. And the key is the numbers game, getting enough trades in there to where you can capture that one big one. You don't know which one. You think all of them are going to do it, but reality is that most of them are going to not do anything or even be losses, and you're going to get that one that makes the majority of the profit. The reason why I kind of laugh at that is I get the question all the time. Well, Jerry, I only have a little bit amount of money, so just tell me the one you really think is going to work out so that I don't get caught up in the losing trades. I'm like, if I do that, I wouldn't get caught up in the losing trades. I think I want to lose money or be wrong on a trade? No, I think all of them are going to work out. That's why I put money into them, is I think they're going to work out. So it's not about that. It's about the system. You got to run a system. And if you only have a small amount of capital, then you got to hope that the one trade you're getting into is going to work out. And that's always tough if it doesn't. Or you need to try to spread out your risk a little bit more, have smaller amounts in different trades. Or you got to just wait till you build your account up a little bit higher to be able to do those other 2 things. Get into a lot of different trades or be able to spread out that risk a little bit more. All right, so we still have a lot of cash, 116,000, and I still am pretty bullish on Bitcoin. So what I'm going to do here is we're going to pull in that Bitcoin ETF, that BITO. This is pulled back a little bit right here. And I'm going to get into this. I'm going to put my stop down right around this little breakout, just below this little breakout area right here. Maybe down in this area right here. So right around, what is that blow right there? Right around, we'll say 15, it's 1523. We'll say 1525 will be our stop. It'll be a pretty tight stop, but I want it to be a pretty tight stop because we're already right here near a 50% retracement of that move up. If it starts dipping back below here, I might want to get stopped out of that. All right, so we're going to add this one in. Stop price at 1525. 500 shares. 600. 600 shares are right beneath that 10,000. Let's do that. Now, my risk is if I'm wrong, if I get stopped out, I'll lose about $700. I'm okay with that. And let's go ahead and purchase. Oh boy, I got to hurry up. We're late. Real quickly here, a couple of muscle stocks here, new buys. This MNSO looks interesting. Again, just kind of looks like it might be moving up the right side of the bull. Notice the higher lows right through here. Here's a little bit of resistance here. You might want it to break out above as confirmation. I also liked this. Where is it? Oh, it's going to be up here higher. Hold on. That's weird. Anyway, it's DXCM. And again, this one you could kind of wait for the breakout right here, but look at that kind of a triangle formation it's forming. A lot of pressure. If it breaks out, it should continue to move higher. That's a nice looking pattern there. And then under computer and technology sector, this is one you're familiar with, is Uber. Nice little move today after a little bit of a pullback. I like the trend of this one. I'm going to go ahead and get in this one, add this to portfolio, put a tight stop right below this low. So we're not going to risk very much if it does turn right back down. But if the market breaks out, and this, we're going to see if we can get a little bit of a run on this. So this will probably be a little bit of a shorter term type momentum trade here. And so let me add to portfolio. Put my stop at 40, about 41-ish. Say 41. We'll do 200 shares. $668 risk. If we're wrong, let's go ahead and purchase that. All right. Quick glance at the SPY, still kind of an indecision candle. See how that looks at the end of the day. But you have your spots to look at for tomorrow. We'll have more stocks to consider on Thursday for Thursday's class. But have a great week, everyone. We'll see you Thursday for the stock specific class. Bye now.